Happy New Year, everyone, and welcome to our first pension finance update of 2023. I'm John Lowell. I'm a partner with October 3 in Atlanta, and with me today is Brian Donohue, a partner with October 3 in Chicago. 2022 was a very traumatic year in many ways for pensions, but a very good year in other ways. Brian, what we usually do is we start by talking about the month that has just finished. Why don't you start with December of 2022, and then we can lead into that year as a whole?
Thanks, John. December of 2022 was kind of a sour note. Stock markets were down maybe about 5% and interest rates up a little bit. So the traditional pension plan that we track in our finance update lost about 3% last month. For the year, just rounding out the conversation that we had last month, that traditional plan actually ended up about 5% ahead. We also track a LDI plan, and that plan lost about 1% on the year. So, we think 2022 overall was kind of a neutral to positive year for pension sponsors, both assets and liabilities down significantly, but the net effect looks to be positive. But it's hard to generalize about 2022. For example, just within the stock market, the S&P 500 was down 18%. NASDAQ was down 33%. If you look at different bond investments, an aggregate bond portfolio was down maybe 13%, a long credit portfolio, 26%. And on the liability side, short duration plan, mostly retired or cash balance, was down maybe 15%. A long duration open ongoing plan might have seen liabilities down 30%. So under the hood, a lot of variability in what is otherwise a neutral to positive year.
That's great, Brian. Thanks. As you and I have talked about this, what the pension finance update really does is it measures as much as anything what the pension balance sheet looks like. So it's really focused on those companies who are looking at a fair market basis balance sheet sort of picture for their pension. In our experience, a lot of those are very large companies, but certainly other public companies or other companies that are focused on accounting would think about that as well. How did those companies fare during 2022, and what might they think about for 2023?
Yeah, so you're right that it's fair to think of the pension finance update as a tracker of a corporate balance sheet, which is generally a pretty transparent and straightforward calculation. A lot of your large employers are going to be really focused on the income statement, the P&L impact. And that is a much more complicated, much less straightforward calculation. As far as we can tell, though, the experience in 2022 will generally translate to lower 2023 expense than we would have thought otherwise. There's a lot of reasons we could go into for that. We think particularly ongoing plans are going to likely see a positive experience. But an important conversation to have with auditors this year might be about increasing your expected return on asset assumption. That's an assumption that employers have been decreasing for decades, but the spike in interest rates this year, I think, provides some justification for looking at that assumption, and that would certainly help with the 2023 P&L.
That's really interesting. Another group of plans, though, as we look at all these frozen plans out there, and presumably most of them are looking for ways to get to plan termination as quickly as possible. How did 2022 affect them? Is 2023 going to shape up as the year to get out of those plans?
Yeah, we think that there are probably hundreds of plans that are maybe closer to being able to terminate than they appreciate right now. As I mentioned, that traditional plan A that we track for the pension finance update improved 5% for the year. So that's a plan with a traditional asset allocation, 60% stocks, 40% in aggregate bonds. Large employers are often doing very sophisticated asset strategies, but you're likely to see this sort of traditional 60-40 among some of these smaller plans, $50 million, $100 million plans, smaller even. So those are plans that are likely have enjoyed a good year in 2022. On top of that, we know that for pretty much all pension plans, 2021 was a very good year in terms of stocks rising and interest rates going up a little bit. So, yeah, we think there's a lot of plans that might be close to being able to terminate, and that really puts a premium on a real-time funded status, on understanding where your plan is right now, because these things change quickly.
That's great. And I guess the third class, at least the way I would think about the plans out there and how the pension finance update affects them, are the plan sponsors who are really concerned about cash flow. How much am I going to need to contribute in 2023? What did 2022 do to them? What should they be thinking about?
Yeah, the answer here is a little counterintuitive, because we've already said that 2022 looks like neutral to positive on the balance sheet, likely going to produce positive results for 2023 P&L. But when you look at what it means for cash flow or for the ERISA funding rules, what's happening here is we're going to register a lot of the decrease in assets during 2022, but we're not really going to pick up the decrease in liabilities, because we're measuring liabilities under funding relief. So when you net that out, what we see is 2023 minimum contributions are going to be higher than what we thought a year ago. 2023 FTAPs and AFTAPs are going to be lower than what we thought a year ago. Companies, hate getting blindsided by contribution requirements that they didn't foresee. I think there's a premium on understanding where your plan is right now and trying to avoid an unexpected, cash flow hit this year.
That's really interesting. The way the companies that focus on cash flow really have a different perspective than companies that are focused on their pension accounting. One of the things you mentioned toward the end there was the whole concept of FTAP. And when I think about FTAP, I think about the ability to settle some pension debt, either through lump sum windows or through pension risk transfer, or some people might think of as annuity purchases. Is 2023 going to be a hot year for those or not? What do you think?
Yeah, I mean, we've seen this trend for a decade now, John, right? Just particularly annuity purchases mounting every year. Lump sum windows maybe maxed out a couple of years ago, and they tend to kind of go up and down based on company strategic calculations. But 2023 looks like a great year for settling liabilities. As we've discussed, we think there's lots of plans that have improved funded status in 2022 on top of an improvement in 2021. If you're a frozen plan and you're close to fully funded, there's no reason not to head for the exits. Also, the pattern of interest rates went up in the end of 2022 and have come down now. So there is a little bit of a spread in paying lump sums to participants in 2023 for employers that use the look back 12-month look back period. Just one final observation, the lower AFTAPs in 2023 mean that there are sponsors that could have settled liabilities in 2022, but maybe won't be able to if they fall below 80% in 2023. Those are the sponsors who are probably most interested in settling liabilities, because when you're underfunded, you're generally at the PBGC variable premium cap, paying maximum premiums. So, there are employers out there that maybe had an 83% AFTAP in 2022. Because of the way the smoothing works, they could be below 80% this year, not able to affect settlements. But there is a presumption rule for the first quarter of the year that allows you to use your FTAP from the prior year. So these employers actually do have a window between now and the end of March to do an annuity purchase to take out a chunk of overhead costs without having to make a big contribution to make that happen. Just another reason why you want to get your valuation results earlier in the year, just to maximize your opportunities.
Great information, Brian. Thanks very much. And for all of you who joined us this month, thank you for listening. We hope we'll see you again next month. Until then, good luck with your pensions.